looking at disclosure. So you'll see chapter 7 actually relates to chapter, I think it's 15 in this textbook, where they look at consolidating all your separate sections. Right, so are rules important?
Yes.
Why?
Because you need to know your rules to use it in your accounting.
Correct, even for adjustments, eh?
Yes.
Okay, so adjustments still follow the rules. What is depreciation?
It's like, for instance, if you use a vehicle over a year, then the worth of the vehicle depreciates.
Which one?
Oh, it's an expense.
Correct. What is accrued income?
It's a liability.
What does accrued income mean?
It's money that accrued income is an asset because it's money that needs to come into the company.
That's better. What is income received in advance?
It's a liability because we still owe a service to a client.
Perfect. Accrued expense?
It's a liability because it's an expense that occurs or that occurred in, say, 13 months.
Okay. Which one did I do? Accrued income? Oh, accrued income I did. Prepaid expenses. What's a prepaid expense?
It's an expense that we've paid for, say, 13 months instead of 12 months.
So that makes it a?
Overpaid.
Correct.
It's an asset.
Exactly. Right, so those are all accounts that we need to know. Why? Because we're looking at this, the last step. Okay, so we need to create a set of financial statements that are accurate. If the statements are going to be accurate, I need a trial balance because the trial balance checks that the debits are equal to the credits. That's why we've got them. Alright, the trial balance is basically a way to check or confirm that what I have in terms of my books are in line with the double entry rule. Okay, if everything's in line with the double entry rule, am I going to record things now in the statements?
Yes.
Yes, because then things are accurate. Now I can draw up those statements. Right, so the next bit is some recap looking at periodic and perpetual. Do you still remember what the difference is?
Perpetual is cost of sale and periodic is
No cost of sale, meaning you have to find a formula. Do you agree? We need a formula for periodic. Do you agree?
I can't remember the periodic.
Okay, we'll recap it later. We haven't covered it yet, but I'm just revising something that you would have discussed in 1501. Okay, so we haven't looked at it yet in this chapter, right? Because it's still coming. I think that's chapter 10. Okay, in this study unit. All right, so it's a bit later. But right now, we've just got an idea. So maybe just a note here for those two. You can say see later, which is inventory. Right, because inventory.
They still ask this you'll see it in the assignment 1.
Yeah, they do, because assignment 1 covers, I think, the first 10 or 12 chapters. Yeah, the first assignment covers quite a lot in terms of basics and separate sections. Okay, so we will look at it again in more detail. Right now, we're just looking at this, closing transfers. Because what am I looking at doing? Creating a set of financial statements. And when are statements created? At the end of the year. And must I account for all the transactions during the year?
Yes.
Definitely. So the accounts have to be accurate. So the accounts need to provide for income and expenses. If I'm calculating gross profit, I'm going to do that in my trading account. Okay, because gross profit, you would have covered that before, is what? Sales minus cost of sales. Right, so if you're selling something, if you've got an amount that you've received, it's seen as a sale. Obviously, there's a cost of every sale. You had to buy something before you can sell it. So if you're buying something to sell, then your cost of sale would be your expense. Okay, so the income here is the sale, and the cost of sale is the expense. And we know income minus expenses gives me a profit. Okay, so gross profit is what I get. And gross profit is calculated from the trading accounts. Right, then you've got profit and loss. What profit do we calculate there? There's the answer, net profit. Okay, net profit is after all my other income and after all my other expenses. Okay, but we'll look at that later on when we do more examples. First things first is the T account for trading account. What is it going to look like? Well, you're going to have a debit side and you're going to have a credit side. There's the equation. I gave it to you in the notes. Sales minus cost of sales is gross profit. Okay, so if you know what the equation is, can you work out the profit? Yes, you can. Who gets the profit? The owner. So if the owner gets the profit, will the owner's capital go up or down?
Up.
Correct. So where would capital go up?
On the debit side.
Capital.
Yes, it's an asset.
Capital isn't an asset. Capital is capital.
Oh, shucks, you're right.
Capital is capital. So capital will be
Credit.
credited. Okay, so the profit that's derived from the business will be taken through to who? The profit and loss. Right, because here I had sales. So if I put this in my equation, 2 million minus 1 million is 1 million. Does that make sense?
Yeah.
Okay, so if I'm looking for the gross profit, I can work it out manually or I can work it out in which account? The trading account. Okay, because trading means you're buying and selling. Right, so if I'm looking at buying and selling goods, I'm going to have a cost of sale that's associated with the sale. Right, so if I subtract the one from the other, I'm going to get the profit. We just said the profit's entitled to who?
The owner.
Or I should say, who's entitled to the profit? The owner. Okay, the owner is entitled to the profit. Right, he or she is going to receive the full benefit of the business in terms of generating a profit or a loss. Okay, so what is the profit or loss account going to look like? I think I wrote it down here. Yes, I did. Right, so have a look here. What do we do to the trading account, debit or credit? We debit it with profit and loss. If I'm debiting the trading account, what am I going to do to the profit and loss?
You're going to create it.
You're going to do the opposite, okay, because there's the debit. So the credit's going to be here, and then you would put trading account here. Income has a credit. Wages is an expense. Wages will have a debit. Okay, so when focusing on the profit and loss, the profit and loss account is going to record the gross profit, which is the trading account, plus any other income minus any other expenses. Okay, I'm going to increase it and I'm going to decrease it by the income and expenses. And then I'm going to be left with an amount that's going to be closed off to who? Correct, the owner. Right, so let's discuss these. I want to know why am I debiting and crediting these accounts. Right, what system am I using here? Perpetual. What do we call inventory when I use perpetual? Inventory is inventory when I use perpetual. How do I know if the question is giving me perpetual or periodic? I've got this. Cost of sales. Right, so when you see cost of sales and inventory, then you know you've got which system?
Perpetual.
Perpetual, correct. Okay, and if it's perpetual, what does that mean? I'm accounting for the cost of sales. So when I have a sale, will I have a cost of sale?
Yes.
Of course I will. Right, so describe the first transaction. What's happening here? Buying merchandise or stock or goods. Why do I debit inventory? Why do I credit bank or creditors, depending?
Okay, inventory is an asset.
Inventory is an asset, I
And
agree.
the asset increases on the debit side.
The asset does increase because I'm buying stock.
Yes.
Right, so if I buy stock, two ways of buying stock. Cash or credit. So what account will I debit and credit? I'll debit the inventory and credit the
bank.
Correct. If it's cash, or credit the?
The creditors.
If it's?
Credit.
Perfect. Okay, there you go. Right, so it all depends on how you're buying the stock. I'm either using cash, so the business's resources, or I'm using someone else's resources in the form of credit. Using a liability to buy the asset. Is that okay?
Okay.
Right, so what happens if I'm not happy with the stock and I return it?
Then you debit your creditors.
Good, because are they going up or down?
Down. Or up.
Correct, you're right.
Yeah.
Don't hesitate, you're right. Okay, so your creditors are going down because are you going to owe them more or less?
You're going to owe them less.
Perfect. So you're right by debiting the creditors. And tell me why I debit the bank.
Because money is going into the bank and not out.
Correct. You're getting a refund for the goods that you returned. Does that make sense?
Yes.
Okay, so asset and creditors affected. Asset decreasing. Why? I'm returning the inventory that I've bought. Okay, still perpetual, but now we're looking at the sale. What's special about perpetual? Do I need to account for cost of sales?
No.
Yes, for perpetual I do. Okay, because perpetual means keep tally of all the goods all the time. Do you agree? Okay, so if I'm selling land and buildings, or, okay, that's not a good example. Let's rather use selling a vehicle or machinery. Okay, you guys are selling machinery, right?
Yes.
So if you sell machinery, are you going to debit the bank and credit the debtors? It'll be either or, right? Depending on?
Okay, yes. Yeah. If you sell on credit,
Then it's?
or if you sell with cash.
Okay, so if it's on credit, then it's debtors.
Debtors.
And if it's sales?
It's bank.
If it's sales,
Oh.
it's sales. Right, because it's a credit sale, then it'll affect the debtors. And because it's a sale, it'll be a credit for the sales.
Okay.
Right, that account will be going up. Must you account for the cost of sales?
Yes.
Why? Which system?
Perpetual.
Perfect. Perpetual requires two parts to a sale transaction. Is that okay?
Yes.
Right, debit cost of sales, why?
Because you need to know your expenses.
Yes, that's the expense, and then you've got an asset that's decreasing. Okay, so when we have cost of sales, we always have the perpetual system, because the perpetual system is built on the cost of sales.
Okay.
Okay. Can you explain what's happening here?
Okay, so sales returns is an expense because
Good.
we need to give money back.
Perfect. So customers that bought for cash or customers that bought on credit aren't happy with the goods that they've bought. What do?
So bank
Return
will
the goods.
decrease.
Yes and no. Customers returning goods. Well, yes, you're right. Sorry. Bank would decrease because if it's cash, the cash will come down.
Yeah.
If there wasn't cash, then what would decrease?
Debtors.
Correct, the asset, yes. Okay, so the asset will be decreasing. Either you're going to refund those customers, or you're going to remove that from their account in terms of what they owe you. Right, so they'll owe you less if they return goods. They'll owe you more if they buy goods. Okay, if I've got perpetual, must I still account for the inventory?
Yes.
You have to. So am I going to reverse out the previous transaction?
Yes.
Yes, I will. Right, and then I'll debit and credit. Debit the inventory and
Credit cost of sale.
credit cost of sales, 100%.
Okay.
Makes sense. Not too bad, right?
No.
Okay, because you're reversing what you did initially. Right, now we're changing system. Now we're using periodic instead of perpetual. That's the one that we had earlier. So if it's periodic, what am I going to do? What do I call inventory if it's periodic?
Purchases.
Perfect. And what type of account is purchases for the periodic system?
Expense.
Purchases is an expense. Good. So you would debit the purchases because you've bought or sold.
Bought.
Exactly. Right, so if I've bought goods, I'm going to affect the purchases positively. I'm going to increase the expense. Okay. And then why did you increase the expense?
Because it's money going out.
It's money that's owed, okay, or money going out, either or. Right, so if you're looking at the money part, it's credit the bank, and if you're looking at the owing part, then it's credit the liabilities. Yeah. Got that?
Yes.
Right. Are those goods always what we expected them to be? No. So if I'm going to be returning goods, what am I going to do to my accounts?
Okay, bank will then be debited because it will be increasing because it's money coming in now.
Correct, because it's a refund.
Yes.
Perfect. And will I owe more or owe less if I return goods to the supplier?
We will owe less.
You will owe less, 100%. Right, so what account do you think purchase returns is?
Income.
Perfect, the opposite of purchases. Nice. Got it.
Yes.
Okay, let's motivate here. Which system? Periodic. What's happening?
We're selling stock.
Selling stock. If I'm selling stock, which journal?
Bank will increase because we're receiving money, and sales will increase because it's a sale.
Yes. Okay, so that is a cash sale. So what you've described there is the cash sale. Debit, bank, credit, sales.
Okay.
Will there be cost of sales here?
No.
No, because the system is
Perpetual.
periodic, is right.
Oh.
Okay, so periodic is going to utilize expense account to represent the inventory. The inventory is then going to be offset against the opening and closing stock, and you'll be given a closing balance. Am I going to have to do a stock take or reverse out inventory that was sold, that it was later returned?
Yes.
Well, depending on whether they return the goods or not, it's always going to be included in what line item? The cost of sales. Okay, because the cost of sales will tell you exactly what the balance is in that account for that year or for that month. Right, so cost of sales is what type of account? Asset, liability, income, expense, capital drawings.
Expense.
Cost of sales is an expense. So debit or credit?
Credit. Oh, debit.
Expenses have debits.
Debit, yes.
Yes. Okay, do you need this equation?
Yes.
Yes, you do. Right, for what system?
Periodic.
Periodic. Only for periodic. Not for any other situation. Right, so then you've got a note here about the trading system, okay, the trading account. I've just summarized what they've given you in the textbook and the study guide. Okay, what's happening here? Describe each and every one of these line items. Let's start with sales. What happened? How did we get 9, not 9, how did we get 500?
It's money coming in because we've sold something.
For what?
What do you mean?
Cash or credit? Does it matter here?
No.
No. So with the trading account, you're just looking at your cost of sales and your sales. That's it. Okay, earlier we spoke about the difference between net profit and gross profit. Is a gross profit something that I can calculate?
Yes.
How do I calculate the gross profit?
It's your profit minus all other income and all other expenses.
Gross profit. Sales minus cost of sales. You're thinking about net profit. Net profit's fine, but that's the what did you say? Cost of sale, not cost of sales, capital plus profit or minus loss minus other expenses. Okay. No, because we're looking at net profit. Net profit is plus other income minus other expenses. Okay, because it's taking the gross profit into consideration. Okay, so if I'm focusing on cost of sales, I'm going to have opening stock, closing stock, because do I need to calculate the cost of sales? Yes. Okay, so earlier I had that equation, right? There's the equation. What is my opening balance in this question? 50, correct. Okay, so 50. How much was the, let's see, cost of sales is plus purchases, so 200. Carriage and purchases, 0. Minus closing stock of how much? 100. Okay, and that gives me, was it 150? Where is it? 100. Inventory closing stock.
50 plus 200 is 250 minus 100 is 150.
Okay, you mean the answer? It's 350, not 150. 50 plus 200
minus 100.
Minus 100. You can't minus 100 because at that side there's still a balance here of 500.
But why did you say minus 100?
Minus 100 is for the closing stock, because that's the calculation for cost of sales. See here? Closing balance. Returns, other, purchases. Okay, so 50 plus 200 plus, 0 minus 100. Okay, gives you the cost of sales. Okay, is the cost of sales the same as the one that we've got in my answer, my solution? Well, what is 50 plus 200? That's 250. 250 minus, no, not minus, plus 10 is 260. 260 minus?
Why plus 10?
Because it's other costs. Oh, sorry, I'm reading this as a 10. I'm reading it as a 10. Sorry, the writing is bad. Okay, sorry. Okay, it's 50 plus 200 plus 0. Okay, minus 100 gives you? 150. Yes, happy with that. Yeah, sorry, writing badly with the mouse. Okay. Right, so why don't I record the cost of sales? Because I keep stock, and I add, and I calculate the total stock on hand. Okay, if I know how much stock is on hand, do you agree the difference will be the amount that I sold? Okay, so if you start with, let's say, 10 items and you buy an extra 100 and then you count how much you have left and you only have 20 items left, how much would you have sold? 10 plus 100 is? 110. And you've still got two assets left. So you must have sold?
108.
The difference.
Yeah.
Okay, the difference for it. Okay, so when looking at periodic and perpetual, see, this is what you've covered before. I'm sure the slides even look familiar. Okay, so when I have perpetual, what's the vocabulary that I need to use for perpetual? Inventory, 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 inventory. Okay, always, always, always inventory. Okay, and if I've got periodic, then it's always called purchases, 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 purchases. Okay, so the only big difference here with periodic and perpetual is periodic requires a formula for cost of sales. What is the equation for cost of sales?
It's the sale, oh, it's the income, no, okay, for cost of, is the sale minus expenses.
Sale minus expenses? Almost. What's happening? Buying and selling goods. Okay, so sales minus cost of sales is gross profit. Net profit is gross profit plus other income minus other expenses. If I've got perpetual, I call inventory inventory. If I've got periodic, I call purchases purchases. Right, if I'm focusing on donations, a donation would be what? A benefit or a disadvantage?
Expense.
It will be a benefit for the person receiving the donation, but a decrease for the person paying the donation or giving the donation. Right, so if I've got perpetual, which account do I affect? Inventory. Why do I affect inventory for a donation? What am I giving away?
An asset.
Well, an asset in the form of a donation, okay, which would give rise to what? A debit or credit for the donation.
Oh, a debit.
A debit. Why do we have a debit?
Oh, it stands there.
Is it decreasing or increasing?
The asset is decreasing.
The asset is decreasing. That's fine. We've discussed that. What is happening to the donation?
It's an expense.
Yes.
It's increasing.
Good. Okay, so the donation is an expense that I need to record in my books. For the increase. In the expense, yeah. Okay, if it's periodic, do I call donations anything other than donations? No, I don't. I just name inventory purchases because now inventory is going to be treated as a periodic inventory management system. Okay, so purchases represents the buying of stock. Right. What's going to happen to drawings if I take from the business? Decreasing what? Which one? I'm drawing. So I'm drawing as the owner. What am I decreasing in the business?
The asset.
The owner's asset, yes, because the owner's taking inventory. You're right. Okay, so if I'm taking from the business, if I donate, I'm also giving away. Okay, so donating is giving away stock. Drawings would be taking stock. Okay. If I take stock using the periodic system, then I'm going to have drawings and purchases. Right, so it's just the language that's being used. That's the biggest difference here. I either use inventory if I've got perpetual, or I use purchases if I've got periodic. Will they tell you which one you've got?
No, you need to know which one they're using. Sometimes they tell you.
Sometimes they tell you, but more often than not, they won't. Especially in the exams. Okay, so in the exam question, you're going to have to identify which one you've got. How do I know if I'm dealing with perpetual?
Inventory.
And cost of sales. You'll have cost of sales. How do I know if I've got periodic?
Purchases.
Good, that's the key one. Purchases. You could have purchases, you could have carriage and purchases. You could have other costs. Okay, those would be costs that relate to the stock. Okay, carriage and purchases, other costs, import duty, export duty, all of those things. Okay, it's specific to the inventory. Okay, so if it's specific to the inventory, it's classified as part of the purchases. Okay, that's why you get carriage on purchases. or you get custom duties. Right, so it's something that relates to the purchases. Okay, if it relates to the purchases, then I need to record it. Okay, on the credit side, because I'm decreasing what I got because I'm drawing it or because I'm donating it. Okay. Alright, these are steps to process the actual closing transfers. Right, it's better to actually see a worked example. So we can't do any of this yet because you haven't covered all the separate modules. Okay, so when you've covered all these modules in this study guide, you're then going to be able to consolidate and create a statement. Okay, where you'll have statement of comprehensive income and a statement of financial position and a statement of changes in equity. Okay, and then you'll show the movements and you'll calculate the profit or the loss, and you'll close off specific accounts. Right, so if I'm closing off an account, would I want to close off those accounts to a specific line item? Yes, and that line item is called the capital account. Okay, because what is capital representing? The owner's equity. Right, so do you agree the owner is entitled to everything that the business makes?
Yeah.
Do you agree?
Yes.
So if the business is doing well, then the owner's going to get more or less?
More.
The owner's going to get more. So will it be a debit or credit?
Debit. Yes, sir.
Credit. If the owner's going to get more. Which account represents the owner?
The income. So.
The capital. Doesn't the capital account belong to the owner?
Oh, yeah, sir.
Okay, so if the capital account belongs to the owner, if the business does well, what's going to happen to their capital?
It increases.
It's going to increase. And if the capital is going to increase, will I debit or credit?
Credit.
Correct. I'm going to credit. Right, so that means that capital will increase if there's a profit. Okay, but you've seen that before when we looked at the equation for capital, which was capital equals capital plus, or owner's equity rather, I should say. Owner's equity equals capital plus minus the profit or loss, and then minus the drawings. Okay, depending on what you've got. Okay, but like I say, don't stress about these steps. You don't have to study these steps off by heart. You'll see when getting to questions, it'll be quite self-explanatory as long as you just practice. You'll see you've been given like a statement, then you have to close everything off, and then you calculate a profit, and the profit goes to who? The owner. Okay, so as long as you follow the process through. Okay, so what's the first step? Selling something. If I sell something, there'll be cost of sales. That gives me a gross profit. After gross profit, I need to calculate a net profit. After net profit, who does that go to?
The owner.
Exactly. And what account represents the owner?
The capital.
Exactly. Okay, so for now, I don't want you to worry about exercise 7.1 in the textbook, or study guide, I think it is. It's just too complicated. All right, because you're going to have to close off accounts for all these different line items. All I want you to do is just appreciate the look of those statements. Okay, so let me show you what it looks like. 127. Okay, so that's where the activity starts. Grab that. Okay, so if you turn the page. Okay, what are they giving you there? Journals. Why? What's the next step after having received transactions? Record them. Don't you record transactions in the journal?
Yeah.
Okay, now once you've got the journal, what do you do with the journal? Give me the next step after the journal.
Statements.
No, statements is the last step. After the journal, where do you put your journals? In the
General ledger.
general ledger, exactly. So after journals, then we have general ledger. General ledger is going to have all the different accounts. One for drawings, one for capital, one for blah, blah, blah. And then, what do we calculate from the journals? Not journals, from the ledger. Trial balance. Remember the steps we saw at the beginning? You had that diagram. Okay, and then there's the diagram. Right, after the trial balance, then the last step is the financial statements. Okay, so that's what they're showing you here. They're showing you journal, posted to, ledger, posted to, closing off, profit and loss. Who gets the profits? The owner. And that's ultimately what you're going to have to create. So these are the different statements. Okay, for who? For the owner, representing everything that happened during the year. Okay, so whatever happens during the year, I need to record. Okay, so what type of business is this? Service entity. Will a service entity have a gross profit?
Yes.
A service entity. Will a service entity have a gross profit? What is a gross profit to a business? It's the amount that we buy or sell.
That we sell.
Well, we do sell because it's a gross profit, so we'll have sales. If I've got a service entity, will I have a sale?
Oh, no.
No. Okay, so you don't have a trading account for a service entity. No trading account, because they're not trading in terms of buying and selling goods. They're rendering a product, a service actually. Okay. Right, what type of business do we have here? Trading entity. If it's a trading entity, can I have sales and cost of sales?
No.
Trading
yes,
entity.
You can. Yes, you can, sorry.
Yes, because I'm buying and selling goods. Okay, so a trading entity will have a cost of sales and a sales figure because you are buying and selling goods. How am I going to account for those goods? Well, it depends. Here, I'm accounting for the goods using a perpetual system. So if it's perpetual, will I have cost of sales? Yes, I will. Okay, because that's perpetual. Okay, so with perpetual, I will have cost of sales. So then do I need to work it out?
Yes.
No, I don't, because I'll have cost of sales.
Oh, yes.
Right. I only have to calculate cost of sales for which system?
For the periodic.
Correct. Okay, and that's why on the next bit, you've got this, the inventory account that you need to close off. Okay, because inventory is an account that we need in order to help us calculate cost of sales. Cost of sales comes from inventory, because you'll have opening stock, which will probably be debited, and then you'll have closing stock. Right, and how do I calculate the cost of sales? It's the opening stock plus or minus, plus purchases minus any returns plus any other costs minus the closing stock. Remember that equation we saw earlier? This one over here. There's it there. Okay, so that's for what system? Periodic. Okay, then here's just a note about different trial balances. You're not going to see post-adjustment trial balances. You will always be given this one, pre-adjustment trial balances. Why? Because you have to adjust. Okay, because UNISA will obviously give you something that you need to provide for in terms of an adjustment. And that's why this homework exercise that you had was an adjustment exercise. Okay, we're adjusting what we have in the trial balance before we create the statements. Okay, because the statements need to be correct. And the only way statements are going to be correct is if I check that the debits are equal to the credits. DR equals CR. Okay, that's the only time I'm going to be able to check if it's the same. Right, so there's an integrated example here in your study guide in this book. It's 7.5 on page 143. Okay, it's impossible to do page 143 if you haven't completed the next few chapters. Okay, because it takes you through the entire process. Right, so notice pre-adjustment trial balance. Then you've got additional information. Turn over the page.
Sorry, can I just write here?
It's a consolidated exercise. You can't do it now, we can do it later.
Yes.
Right, and then you've got the solution. So what's the first step? Post to your journals, which they've actually, I think, given you here. Did they? No, they didn't. They must have done that for you. Yeah, integrated example. Okay, so they haven't given you the journals here. They started from journal to ledger. Right, so we're at the ledger stage. Once we're at the ledger stage, what happens after that? Trial balance. Okay, we need to check the trial balance balances. If it does balance, then I need to adjust. Okay, so the adjustments are what we've got over here. See, these are all tier accounts. These are adjustments. Those are adjustments. After the adjustments, then I do what? Financial statements. Okay, and financial statements are going to be used to calculate the profit or the loss. Profit or loss. Okay, and obviously we get different statements, and then that was what you did right at the end of FAC 1501. You had to draw up a little bit of statements. Okay, then we had to look at, well, was this an asset or liability? If it was an asset or liability, which statement does it go to? Statement of financial position. Remember that? Okay, and if it was an income or an expense, which statement did that go to?
Sorry, say again.
What did you miss? Financial position records which two accounts?
The profit and loss.
No, the assets and liabilities. Okay. The statement of comprehensive income, or the statement of profit and loss and other comprehensive income, that statement records the profit and loss. See, and that's why they've given you some closing entries there. Okay, because we're closing off the accounts in order to calculate the profits. Okay. Right, these are some tips that I've found useful for students when approaching exam pass papers. Okay, so with this, I've found this helpful for students when approaching tests and exams. Okay, because obviously we want to get to those past papers because that's where everything comes together. Right, because remember, all of this in your textbook is bits and pieces covering bits and pieces here and there and everywhere. Okay, the past papers sort of bring it all together. Right, and that's why the key to doing well in any accounting module is just to do past paper over past paper over past paper over past paper. Right, that's how I want to try get to past papers as soon as we can. Obviously, we need to still cover the material, but once we get there, then we can practice. Because then now we're taking a little bit from this chapter, a little bit from that chapter, a little bit from that chapter. Okay, because that's what's happening here, is that you're taking, so for example, adjustments was covered in the previous module, study unit 6. Okay, so that's just adjustments. So when I get a question, I'm going to look, do I have adjustments here? If I do, then I know I'm going to use study unit 6. Okay, then you might have a question where there's a question about inventory. Then that's periodic and perpetual. And then in this textbook, I think it's study unit 10. Right. But see, we've covered inventory already. We covered it in 1501.
Yes.
It's exactly the same in 1502. And then the other one was, depreciation. Same thing. You see depreciation again here. We covered it before. They just take it one step further. The only thing is the asset disposal. That's the only thing that we haven't done yet. Okay, we've covered depreciation, so you know straight line, you know diminishing balance from 1501.
Yeah.
You just don't know how to do asset disposal. That's the only thing new in this module. Okay, but you see, that's why when you get a question in the exam, you need to like pick and choose which study unit I'm referring to. Okay, that's why it's so challenging, because you just need to join all the dots. Okay, so at the moment we're just getting like dot, 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 covering different topics. Okay, at a later stage, we're going to join all the dots, and then we're going to create this, the financial statements. I didn't write it on this slide, but I'll write it at the top there, financial statements. Okay, so how do I create the financial statements? By analyzing the transactions and by processing adjustments. That's the first thing.
Say that again.
Analyze transactions and process adjustments. Analyze transactions and process adjustments. Okay. Right, so when focusing on this, we need to remember study unit 6. Okay, and that was what we spent time revising earlier because you were a bit worried about that section.
Yes.
Okay, so now we drew some nice diagrams and things like that, so that should be a little bit better in terms of understanding what a prepaid expense is versus an accrued income versus a income received in advance. Okay, and then you just need to remember these accounts, okay, because they're used to calculate something specific. This is used to calculate gross profit. This is used to calculate net profit, which is given to who? The owner. Okay, so profit and loss gives you the net profit. Trading account gives you the gross profit. They're both profit calculations. Okay, and then this section that we just covered now, which is study unit 7, this is looking at the closing transfers. Okay, so closing means to take those trial balance amounts and to close them off to who? To the owner's equity. Okay, in other words, calculate profit and close off the accounts. That's what you're actually doing in study unit 7. Okay, and that's why this exercise is so long, because they've taken you through the entire process. Okay.
I'm sorry. No, don't worry.
Okay, so the accounting elements always help. That's why you know the DETLIC acronym that you use to remember the rules, the debit, expenses, assets, drawings, and the liabilities, income, capital, credit. That's important to remember because at any point in time, it doesn't matter where you are in the process. You can be at the start looking at transactions, which you did a lot of in 1501, or you can be at the journal stage where you're recording the transactions, or you could be at the general ledger stage when you're drawing up T accounts, or you can be at the final stage, which is this, the adjustments, closing transfers, and financial statements. Are you always going to need to know what you're dealing with?
Yes, you need to know.
Of course. Okay, if you don't know what you're dealing with, then you won't know how to process the adjustments. Okay, that's why it's so important.